Hello, everybody. Bert Cope with New Life CFO Services, and thanks for spending some time with us today. In this little journey, we're going to go through what we do at New Life and how we think that makes us different and different to better serve you. Again, as a reminder, we were given this tag a long time ago when I first started the company about, well, you're just entrepreneurs that happen to be CFOs. And if you watch the first one, I explained it, but for the most part, let me just recap. We hire CFOs that have operating experience, which means in addition to having sat in the CFO seat for 10, 20 years, they've also had experience as a general manager, as a COO, as a president. And in fact, three of us have owned our own companies. We do that because it makes us a better empathetic partner to you if we also have sat on the other side of that desk. We also look for something else very important in our CFOs. Humility. We want to find CFOs that somewhere in their career, while they've done fantastic, they've also stubbed their toe. Maybe they've stepped in a bear trap. That's important because they've learned how to work out of the tough situations. They know what it's like when things don't go well, and they know how to get out of there. But most importantly, they know what sleepless nights feel like. They know what it's like to say, you know what, honey, we're not going on vacation this year because things are really tight and I got to buckle down and make it happen. So I hope that helps you to understand some of our DNA. With that said, let's dive a little bit into how we define ourselves. So as far as that's concerned, here's our mission statement: to use our God-given financial and operating gifts. We all know that God gave us certain gifts in our lives and in our people, and we think it's important that we maximize those gifts, we play with them, we refine them, and make them as best as possible. But we do that to serve you in a God-honoring way. What better criterion would there be? Because there's very few caveats. You either are or you are not serving someone in a God-honoring way. It's also our internal benchmark of holding each other accountable of our actions matching up to the words that we put on a document like this. Lastly on this is the idea of to proactively engage our clients in a confrontational manner to ensure that your aspirational goals are achieved. Some people ask us, what is confrontational? That's an interesting word. Well, it's not confrontational, right? But it is meaning that we're going to be emboldened to arm wrestle with you, to argue with you, to debate with you, to make sure that those decisions coming out of the boardrooms are the right one. We put that out there very open and honestly because it's a part of our culture. We're going to push, right? We're here to drive for results with you. We want to make sure that those results are the best results, in our opinion. And it's okay if you prove us wrong. It's just not okay to avoid those conversations. And then lastly, what's not on here is we challenge us all the time. You're in that boardroom for a reason. You need to know that reason. Yes, it's to make the company more successful. It's to create opportunities for everybody, including the owner and the management team. But it's important to realize you're in that room to protect the interest of everybody who is not in that room. Most employers take it very seriously that their employees rely on them for good decisions. That's also our part. So if we think that the direction, the initiatives, or something may come up that is more self-serving versus holistically serving, we're going to bring that up. We need to make sure everybody in that company is taken care of. Because let's face it, your company is nothing unless everybody else is there with you and motivated to serve alongside you. As we move forward, some of the other things that we talk about, and we think this is really important for CFO, your financials are basically a historical reflection of your people, decisions, behaviors, processes, and systems. So think about that. You may think about that your CFO is a financial manager, and they are, right? They manage your capital stack, they manage your cash flow, they manage your liquidity, your working capital, and everything else. But to really make your company more profitable, more sustainable, more valuable, they need to be the ones to really ascertain what's going on with your people. Because until they understand that, it's hard to change the performance of your company. So let's look at that a slightly different way. What is the role of your CFO? Your CFO's role if that's true about your people, behaviors, decisions, then your CFO's job is to help dive into not only financials, but the operations, and then help to identify and prioritize which initiatives can change those behaviors, decisions quicker to drive performance faster. And in fact, what we talk about on this is your CFO is really a Chief Financial Education Officer, educating people down the trenches to educating people in the boardroom about how big and small changes can radically change the company and its long-term performance and its ability to sustain those performance. So unless your CFO, fractional or otherwise, is also your Chief Financial Education Officer, you may want to do something else, because that's where the power of what's inside their head becomes the power of what's inside your company. So we believe in numbers, right? Of course, we're numbers people. But why do we believe in numbers? Now, this is a very important deal. If you have, let's say you're on EOS and you have your scorecard, and everybody's looking at your scorecard and it's on track, it's off track, it's green, it's red, it's whatever, right? What's amazing to me is sometimes it'll be red for a long period of time. People go, oh, well, I guess we're not there yet. No, 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 no. If that's true, if that's the reaction, then two things are happening. They don't know how that number should be connected to their personal performance and initiatives. So there's no ownership. And with no ownership, there's no accountability. So your numbers should have direct ownership. They should have direct accountability to everybody in that boardroom. And quite frankly, if you cascade it like you do in the great game of business, everybody in the company ends up owning a number. But what's equally important is this concept right in the middle. Good numbers, good metrics should always, quote, create an appropriate level of anxiety for somebody to take action. So if you're looking at numbers and you're not sitting there going, I'm either okay or I'm not okay, they should compel you to take action. In fact, we like to put some level of target, some level of hurdle of performance in everyone to say, are we there yet? Not are we better than last week? Are we better than last month? Are we there yet? There could be your goal, could be whatever. And if not, the numbers create an appropriate level of anxiety to take action. The conversations turn into not what's the number, what are you going to do about the number? And when you do that, when are you going to be done? And when you're done, what does done look like? What is measurable from being done as we go forward? What benefits will accrue to the company? Those are the important things, and that is what this appropriate level of anxiety drives. This is our proven process. For those of you that are in EOS, you know that you all have your proven process, and this is what we do in delivering results. On the base level, we're going to do a diagnostic evaluation. There's no sense in starting up the engine unless we know what's working and not working. So our practices almost always start out with a deep dive into the structural performance of your company, because we need to know all those nuances, history, and everything else combined with your plans. And then we're going to assess not only the plans, but the skills that you have and your people that you have to execute those. You know, one of the truths of the world is there's a reason why you're not there yet. And it's either focus, it's skills, it's know-how, it's something is the reason why you're not there yet. That's why we're going to assess these skills. And it's not like we're going to come in there and get people fired, because I don't believe in that. But we are going to say, where do people need their skill sets, their toolbox enhanced? What additional practices or something like EOS needs to come in to refine and add discipline to this process? We also look for, are people in the right seat, right place, right seat? And those things are really important, because you could have great people, but if they're in the wrong seat, then we all know that that becomes problematic. And then the last thing that's very important for us is we are going to work with your team to help them understand how to prioritize those initiatives to drive impact quick. Some of that impact, quite frankly, is going to be to drive an enabling resources to take the next step. So we're going to start what's going on structurally. Then we're going to move into financial performance, operational issues, and that's really productivity issues. productivity issues within your products, productivity issues within your execution, productivity issues within your marketing and sales. From that, we can then start doing the competitive assessments about how you look to your competitors and drive strategic initiatives to make you bigger, better, and more valuable as it goes. Lastly, this is a continual improvement process. We're going to assess, quantify, and revise. And the truth of the pudding comes in our monthly summits and quarterly reviews. That's when we stand and deliver and says this is what's working and not working, what's on track, what's off track, what rocks got completed and didn't, and what the expected benefits of these are. We constantly reassess. Again, I'm a huge fan of EOS, so this is embedded like the DNA in their process between their weekly L10s to their quarterly pulse meetings to their annual pulse meetings and having their VTO. Those are great processes. As a little sidebar, if you want to know some great EOS implementers, I'm happy to introduce you. There's a lot of them in the marketplace, but there as well, you want to make sure you have the right cultural fit. And because we know a lot of them, we could probably talk to you real quick about what you are looking for, your culture, your priorities, and give you 2 or 3 recommendations very fast. Okay, so let's keep moving. This is the dynamic about full-time versus fractional. But most people miss like, oh, I think I'm going to hire a full-time CFO. I'm like, really? Do you really understand what that costs and what the cost benefits are? A true CFO is going to cost you a base salary of $250,000, maybe 3 plus. They're going to want 30 to 50% bonus. And they want that because they are driving results that have impact and they want to be rewarded for that. And for the most part, they know that to drive wealth for themselves, they're going to have to be tied to equity. And so it's very frequent that a CFO is going to say, I want some level of sweat equity as I come into this deal or options for equity as we go through it. A lot of those things become non-starters for a mid-market CEO for either giving up equity or having somebody that ends up costing them $450,000. Well, that's a big number. So you better be able to have a big impact. On a fractional, you're really buying what you need. The needs of a company that's 5 to 10 million are very different from the needs of a company that's 50 to 75 million. Depending on skill sets, that's going to be 250 to 3. Some of the most tenured CFOs may have a rate that's higher than that, and you're going to pay somewhere between $5,000 and $15,000 a month, depending on your initiatives and everything else. Now, for us, going back to our core process, our proven process, we're going to do the diagnostic assessments up front. We're going to lay out what we think the impact should be, what the initiatives, impact, and timing should be, and what value those items create. So at least in that way, if you're spending 5 to 15 grand a month, you're going to have a really good idea about what the expected ROI is going to be on that. The last thing about a full-time or a single shingle CFO versus a fractional or firm of fractionals is you're going to have one person, one skill set, right? So depending on your needs, that could be the right fit or not. In a firm of fractional CFOs, and here we have 17 professionals, the largest in this marketplace I think has 35 or 40. But think about the diverse skill sets you're going to get there. There's likely not a problem that you're going to present to that company that somebody in that firm can't solve for you. So keep that in mind, because it's leveraging the skill sets of the entire whole versus the singular one. Size is also very important as it comes to your decisions, because that whole complexity drives the need for full-time. And I'll tell you, 10, 30, and 50 million, there's generally not enough CFO level caliber of work to be done to hire a full-time CFO. That would be universally true except for a few caveats, and that would be somebody that's going through an M&A strategy, right? That could be a full-time CFO, because that's a boatload of heavy lifting. If you're going to grow your company to 30 to 75 million and you plan on doing 1 to 2 acquisitions every year, hallelujah, brother. Go ahead and hire a full-time CFO, because that's a boatload of work. But normally, ongoing operations of continuous improvement, this is a good way to look at it. And we say 75 million, maybe. We tend to exit our clients, frankly, somewhere between 70 to 100 million. Most of our clients don't start out that big. Most of our clients start out in that 15 to 50 million. and then we help them to grow. And as part of that growth is when they start to look at possibly exiting. And frankly, my two largest clients, which got up to 80 million in one case and 120 million in the others, we exited ourselves because we told them it's time for you to have a full-time CFO, and then we help them hire, vet, and transition the new CFO in. At New Life, we really have four areas that we really drive for our primary services. Of course, CFO, strategic results, driving performance of the company, being that chief financial education officer for you, your board, your leadership team, and your company. The other area that we have for our CFOs is really to drive value acceleration, to make your company more valuable, to where it's much more sustainable for you. Like if you want to step out and be working half-time, or to downshift it to your family, to the management team. Value acceleration not only makes your company more valuable, it makes it more sustainable without you, right? It also makes it to when you are ready to go to market, the company's ready. What most people miss in value acceleration is they think the company is valuable based upon what they see. What they miss is what is valuable relative to what a buyer sees. And that's what that level of service is all about. On the accounting side, 1/3 of our business is outsourced accounting and bookkeeping, primarily outsourced controllership, which includes reconciliations, closes, producing financials, variance analysis, and making sure that your books are either due diligence ready, audit ready, or tax ready. The most valuable thing about accounting is enabling you to have good decisions. So a lot of people will only look at their P&L, and you're really looking at the most misleading part of your business. The truth of the matter is if your balance sheet is good, solid, and tied out and accurate, then your income statement is not. Our job is to make sure your balance sheet is in great shape so that your P&L is in great shape, and then help you to understand what's going on. Investor optimization is really looking at the entity holistically to help somebody buy and exit well within 3 years. So it's really a combination of the things that you see up above it, between making sure accounting works really well, timely with great information, driving value, CFO strategic insight, which also drives sustainable, repeatable EBITDA. Now, we know that a lot of people don't understand what a CFO does, so we've actually developed 4 diagnostic services. Remember, that's a part of our proven process. And these are our 4 primary diagnostic services. Insight 29:11 comes from Jeremiah 29:11. Oh, the plans I have for you, declares the Lord, which we think is the most appropriate scripture for financial planning that there ever could be. And what that is to assess the strengths and weaknesses of the company, look at the compositions of your revenue relative to the capabilities of your operations, and then reevaluate the go-forward plan to optimize that to drive EBITDA and sustainable, repeatable margins over a long period of time. We will frequently come across really big strategic disconnects within your company that need to be fixed to make sure that you can move forward. We had one where their cash-to-cash cycle was so jacked up, there's no way that they could grow without consuming excessive amounts of cash. Others, they had product lines that are cannibalizing each other, and it was hidden below really large profitability. Sweat equity into gold, it's making sure that all your sweat equity is into gold, which really has to do with value creation. So it's an assessment to determine what are the things detracting from value, and where do you go from here to correct that. I'll tell you, what it really does is it breaks down the country club valuation that too many entrepreneurs are walking around in their heads. And we're going to touch base with that later on. Accounting wellness is just how well is your back office working? And here's a plan of action to optimize your people. It could be a personal development plan, optimize the processes, and optimize software solutions, including AI, that are available to streamline that, to lower its cost, and improve the reliability of your numbers. Because let's face it, you have to have good numbers if you're going to make good decisions. iBoss is the combination of those to really drive investor value. On Insight 29:11, let me kind of cut to the chase about what that does. We go from wandering in the wilderness to clear direction and priorities. What we look at ultimately is where can we drive results fast in their financial results. They're getting broken problems out of the way so people can do more. And what drives ROI? We then align that on a risk-weighted basis to what are your skills and strategies and long-term vision. How well do these initiatives align with those caveats? We pay very close attention to what are your core capabilities first, right? Because those are the things that are easiest to execute. You already have the skills, you already have the know-how, you can do it mostly in-house without relying on your vendors or customers or other outsiders. We hit go on those. And so by doing this, what it also does, it allows the entire leadership team to lean in and grade out your initiatives to determine which ones will drive performance or build a better foundation faster. Because it's one thing to drive performance, but if you do so on a weak foundation, the odds of you crashing that back down are pretty big. The other thing that's really powerful out of this exercise is it helps to identify the things that you're not going to do now. Where so many companies get sideways is they have too many initiatives and none of them get fully done. So if you're starting out at your own 1 yard line and you drive all the way down to the 5 yard line and you don't get across the finish line, you don't get across the goal line, then you just did 94 yards for nothing, right? Because you still didn't score. So we prioritize that, and we're not going to give up on the things on go hard and fast until they're in the end zone, right? That we've gotten our 6 points. We want all 6 of our 6 points. Once we've done that, then we're going to back up and says, now what's next? Let's put it through the same grading filter and move those initiatives forward. And by doing that on a very disciplined basis, it's amazing how fast results happen that are sustainable, repeatable, and trainable. As far as turning sweat equity into gold, this is really dealing with what drives exit planning and value creation. Now, there's all kinds of things that have to do with exit planning, from your own personal issues, your estate issues, tax issues, business issues, which is really what we do in Insight 2911, legal issues, deal structure. But for us, we're here to create more value. We're here to break apart that country club valuation and then to break it apart so we know what to fix. Too often I'll have people walk around going, oh, everybody in my industry sells for 5x. Well, that's an interesting stat considering that out of companies that actually think about exiting, it's less than 20% exit at all. Less than 20% deals get to a close at the closing table. And out of that 20%, it's actually 17% is the stat from Exit Planning Institute. Out of that 17%, only a small fraction are deals that are really great or phenomenal. In fact, the stats say that I believe it's 50% of people who sell their company or profoundly regret the deal or decision 1 year later, right? That has to do with they haven't created enough value creation to know what their company looks like. So if you think that you're walking around with a country club valuation, your EBITDA is $1 million, and you're going to walk away $6 million, you're not. You're not. You may not even get to a deal. And more importantly, there's a whole lot of things that knock down that valuation from, you got taxes to pay, you have debt to pay off, and everything else. So if you really need X amount out of your business, just know it's not going to be 6. Part of this deal is to look at what's the difference between your value now and what it should be or must be to satisfy whatever's next in your business. We're going to look at the risks and foundation of it, and then we're going to lay out a plan to drive relentless execution to make sure you don't fall in the gap, but you get to the other side very successfully. Here's the universal problem. Entrepreneurs frequently don't step back and says, what does my business really look like to a buyer? They're so focused on, hey, I want to just have more revenue, that's all I want to do. More revenue may not be driving increased value of your company. The wrong revenue can actually be detracting value from your company. So the owner's view of their business is that top line. An investor who's looking at return and risk-weighted return has a different view. And the things in the middle is what I call the pretty baby deal death zone. Your rose-colored glasses prevents you from really harshly assessing your own business so that you can drive it and make it more valuable in the eyes of the buyer, not in your own eyes. Because let's face it, unless you're going to write yourself a check for your own company, It doesn't matter what you see your company as. It does matter what an investor sees it as. So you need your own strategy coming in with where value is perceived by an investor. Marry those two to drive for an outstanding exit. And exiting, 3 of us are CEPAs, which is Certified Exit Planning Advisors. It's a process. It's not an event. If you hear that phrase about, oh, we're just going to put makeup on the pig and keep on going, I'll tell you that's a waste of time. Because every informed buyer recognizes makeup for what it is, and they're going to wipe it off, and they're going to eviscerate your value, and that's where you're going to be one of the 17% that regrets their deal, or you're going to be one of the 83% who didn't get a deal. So the discovery is a deep analysis about what's going on in your company. The prepare is actualizing on those prioritized initiatives. And the decide is, hey, look, we got all these initiatives done. Do you want to just keep on harvesting this greater value, this greater EBITDA, or do you want to sell it? There's no wrong answer there. Keep it in selling a company that is bigger, more profitable, faster growing, to where you're harvesting more from it. That could be ideal. Or you could sell it depending on if the right opportunity comes along. But either way, this is the Boy Scout. You are prepared. You are prepared, not the buyer is prepared. You're there to maximize value, not the buyer there to eviscerate your value. So just know that that's a huge part of it. And when done well, if you combine outstanding foundational strength of a company combined with great growth, you can see what that does to somebody's EBITDA multiple over years. And it's not EBITDA that drives a more valuable company. It's the EBITDA multiple that drives a more valuable company. And the multiple is driven by a lot of factors, some of which are not financially oriented. It all has to do with how sustainable, repeatable your revenues and margins are when you're not there, when your key people are not there. So keep that in mind because it's a huge part of it. And driving and investing into the right markets when we peel that back will help to determine your growth. On the accounting side, this is the number one issue that we come into when we're doing accounting wellness. Title inflation. Do the people doing the work, does it really reflect their expertise? Is your controller really a controller, or are they a bookkeeper that's just been there a long period of time? The same thing goes with your CFO. Are they truly a CFO? Or are they an accountant, your bookkeeper, your controller that's just been there a long time? This is from the movie Ratatouille, and I love a lot of Disney movies. But the real genius here is the rat, not the guy with the chef's hats on. It's the rat that's the genius. So we need to strip down and says, what is the core capabilities of your people, and how do we enhance those? And in fact, at the end of the day, the process ends up with a scorecard that looks something like this. We have people over here, of course. We're going to do culture index, competency and skills test, developmental needs, and growth potential. We're not there to fire your people. That is antagonistic to my DNA. We are there to create a better system for them to succeed, your companies to succeed, and for your financial process that enables decision making to be better than ever. And that includes the controls, the systems, and the core processes. Core processes help to enable great numbers, timely close, and timely presentations to you and your decision makers. So this is what accounting wellness is basically like. And then lastly, iBoss. Simplifying the investor's journey. What we want to get to is, can we get you to a quick turn in 24 or 36 months, right? So we really take accounting wellness, which is this, what's going over here in the back office, to post transactions to drive performance without driving chaos, and the sale to make sure that you're optimizing your value when you want to flip it over to the next private equity group or maybe put it into another roll-up. And what we do is we really assess the back office through our accounting wellness to make sure that that's optimized. The last thing we'd ever want is the new CEO to be jacking around and having to figure out what's going on in the back office and figuring that out. We're going to figure out what's right, wrong, and needs to be fixed. We're going to lay out that plan of action so it works well as soon as possible, as soon as the transaction is done. Post-transaction, our Insight 2911 really drives sustainable, repeatable EBITDA and margins. That's 100% about what that is about. And then lastly, this pre-sale, reduce risk and enhance value. That's where we're really adding in the sweat equity component, and we combine all 3 of these diagnostic assessments to lay out a very holistic plan to drive your ability to exit well in 24 to 36 months. So with that said, I hope you enjoyed our presentation about what we do and how we do it. Uh, and if you have any questions, we'd love to see how your needs and opportunities may fit with what we do. And again, if there's not a fit, I'll be the first one to introduce you to some of my best competitors who would be a great fit for you. I hope that helps you out this week, and you take care.